Do you worry about persistent inflation in the US? Some Fed officers sound more hawkish recently, and when would the Fed start to normalize its policy?
So really, since the beginning of this year, we've been worried about inflation being higher than people think and also more persistent than people think. And if you look at what the Fed is saying, they obviously believe inflation is more transitory, is the word that they like to use. But if you look at a history of the Federal Reserve and you go back to 2004, they used the word transitory to describe inflation in their June of 2004 meeting as well. And then the Fed raised rates by 17 times over the course of 2 years, which ultimately resulted in the global financial crisis. So, clearly their track record on inflation is not necessarily the best, but I think from a risk perspective for them, inflation over the last, at least since the global financial crisis, and you could argue over the last 40 years, inflation has been, lower than people have expected. And so it's less risky for them to just say, okay, you know what, we'll wait. And if inflation's really going to be that much stronger, then we can raise rates and maybe raise it more rapidly. But we won't be blamed if we raise rates and then the economy slows down. And so I think they're sort of taking that view, but ultimately, I think inflation, especially when you look at, the numbers that came out today, for example, you had CPI at 5.4% annualized, you had core CPI at 4.3% annualized. You had that jobs report on Friday where you had over 10 million job openings at that period of time. And then non-farm payrolls came in at over 900,000 for 2 months in a row. And I think those employment figures are just going to get stronger as we go through this year, especially as you have schools opening up. So now you have childcare starting in August, September. Unemployment benefits in the US run out by early September, the extra ones. And then you have over 4 billion vaccine shots globally. And people are catching COVID. And so we're going to get to herd immunity one way or another. I think you're going to have a massive payroll number come September, over 1 million at least. And that's just going to make the Fed move. And I think they taper before the end of this year and raise rates at least once, probably more than once, several times in 2022. My guess is they raise rates 2 to 3 times in 2022.
Do you expect that a rising 10-year Treasury yield going to pull down the US stock market? Is the market going to have a correction?
Absolutely. I think that before the end of this year, the S&P 500 will see a decline of 10 to 20%. I think that'll be driven by the Federal Reserve acknowledging that inflation is not transitory and then starting to taper that 120 billion in bond purchases they're doing a month. And just, to put this in perspective, the Fed in the first 11 and a half years since the global financial crisis, they expanded their balance sheet by $3.2 trillion. In just the last year and a half since COVID, the Fed expanded their balance sheet by $4 trillion. So this is really why the stock market is up, because if you think about this logically and you say, okay, since the end of 2019, we've had a global pandemic that we're still going through. And the S&P 500 is up 37% since the end of 2019. Obviously, that's not based on fundamentals. That's based on all of this stimulus driving stock prices up, driving non-fungible token prices up, driving Bitcoin up, driving meme stocks up. And then you have on top of it all the federal stimulus from governments around the globe. That's why stocks are so high. And if you look at valuations, one of the measures I like to use is if you take the valuation of the entire United States stock market and you divide that by the GDP of the United States, that measures at 2.0 times. At the peak of the tech bubble, that valuation metric was at 1.4 times, and the average for the last 50 years is 0.8. So valuations are extremely, extremely high because of all of this stimulus. So if the market does start to go down, that'll hit the S&P, and then tech stocks will get hit even harder than that because those are long duration assets that are much more sensitive to interest rates.
Then where do you want to be in US market if it's going to have a correction? What would you buy for the second half of this year then?
Well, I think you want to do almost the exact opposite of what you did last year. So last year, when you went into the pandemic, demand for things related to consumers, because consumers got so much in stimulus checks from governments around the globe, as well as money printing, consumer demand in the United States went up a lot. But corporate demand fell off a cliff because people weren't going into the office. There was no reason to spend. If you look at where we are today, because you have 4 billion people around the globe that have gotten vaccinated, the US is over 50% of the population has gotten vaccinated, and that number keeps increasing either through more vaccines or people catching COVID. What you should see this year is enterprise demand is where you want to be, and inflation-oriented names that benefit from rising interest rates. So for us, we like bank stocks. Banks will obviously make more money if they can lend at higher rates. That should help them. They were massive underperformers last year. They're one of the outperforming sectors this year. We think that'll get even better. They're cheap. They have nice dividend yields. Those will all benefit. We also like the enterprise-oriented names. So names like Cisco, for example, or Oracle for enterprise software. These are names that don't have hardly any consumer exposure, and they have a lot of corporate exposure, and so they should benefit as corporate demand comes in. We own Juniper for telecom spending, which we bought after they just reported as well. And then finally, we have bought Chinese ADRs. We put a tweet out on this under my account at Daniel T. Niles, and we have some charts talking about this on my website, danniles.com, but it shows how specifically Chinese internet stocks were down 54% from their peak in February to their trough on July 27th, and how we bought a basket of over 50 of those names because our belief is that they're going to outperform the US stocks, which are sitting at all-time record highs between now and year end.